Upon us. Let's get more on that. Joining us now is Henry Occleston, European macro strategist at Macro Hive. Henry, let's just start with this call, plain and simple. Morgan Stanley says that because of weakening growth and inflation, which is on a downward trajectory, the ECB is done. Would you agree with them?
So our lean at this stage is that there's probably more hiking to be done by the ECB. I think it's a hard call at this stage, particularly for the September meeting. One of the main reasons that we have higher conviction that more tightening is needed is because the ECB has been pretty unequivocal of focusing on their inflation mandate as opposed to their anything around growth or employment. I think the stagflation argument is definitely gaining ground. The minutes mentioned it a lot. Schnabel's comments last week, I think, played a decent role in setting out the sort of neutral ways for and against hiking. But I think that needs to be taken into account or sort of context with a couple of other things, which includes the fact that it seems she's towing the line much better in terms of not shifting too hard one way towards a hike or towards a pause than some of her colleagues. And I think that's reflected in what was agreed at the minutes, or sort of at the last meeting. And the main sort of burning question is employment and the tightness of the labour market. So if we consider where Europe stands right now, they're in a situation where, despite the PMIs, for instance, being incredibly negative, the overall employment growth is slowing but continuing, which is quite sort of at odds with previous sort of recessionary sort of situations. And when we look at their forecasts, which is going to be one of the things that they're really going to sort of lean on with regards to the decision, the reason why they revised up their forecasts so much more hawkishly, and that had been kind of our argument since the start of the year that they needed to, back in June, was on the basis of unit labour cost. So if you're having a tighter labour market, slower growth, that is low productivity, higher wages and higher unit labour costs. So it's going to be a hard one for them to balance that and try to lean towards a lower medium term core inflation rate that would sort of justify that pause. So at this stage, we're sort of much more 50-50 than markets pricing, at least.
Okay, well then, can you have any conviction then, Henry, if you're 50-50, at least on that front, on what happens on the front end of this boom curve? Because German two-year yields, they've really been stuck between let's call it 2.9 and 3%. They've struggled to go anywhere. Where's the next breakout?
So, I mean, whilst sort of on the September we're 50-50, I would say definitely our lean is more towards that they will, one, they're going to be a sort of a terminal rate of at least 4%, seems kind of much more reasonable from a fundamental perspective. And two, the cuts that are priced into next year, so 2024, seem to have been driven partly by just what's going on in the US, as opposed to the kind of fundamental story in Europe. So we still, I mean, our lean is very much towards short the EGB short ends and sort of paying rates there at this stage. Further out, I think further out the curve, I think bonds have been relatively well capped in terms of yield terms, just by the fact that there's clearly, I mean, they're at still at very high yields versus sort of historical versus what sort of market I think is used to, and the fact that supply has really, despite German growth being much lower, the Finanzagentur has managed to sort of really not need to expand supply. Particularly, we've had no real breakouts or blowouts in EGBs. More generally in terms of spreads, partly on account of the sort of TPI, but the story there seems a lot more stable, and inflation expectations definitely into that kind of sort of part of the curve are a lot more capped than say would be the case, I'd expect, in the US, for instance.
So Henry, if I can go back to one thing you just mentioned there, the cuts that are priced in for next year being much more driven by the U.S. Is it your estimation then that the ECB won't be cutting next year? And is there a risk then that policy is unduly tight if we're in an environment where perhaps the Fed is cutting at the same time?
So, I mean, our lean overall is that is more hawkish, both Fed and ECB. I think from a relative perspective, the better value would be the comparison between UK and Europe. So for context, Bank of England, very little priced in terms of cuts next year, almost 3 hikes priced in till they sort of reach terminal rate. And that's sort of sitting in contrast to a Europe where unemployment's still very low, core inflation and particularly wage-intensive inflation in services, for in the services sectors, is still, the momentum is still decently above target. It's quite sort of at odds with each other, so we quite like that play of being sort of positioned for a sort of UK steepening versus European flattening, for instance, in that respect. In terms of will the ECB cut next year, I think obviously a lot can change within a year, so it's very hard to make a very strong call. But I think in the near term, the ECB is certainly going to be pushing back on that pricing. We heard Schnabel already sort of talk about the fact that the market basically being more dovish on the rate further out is taking out some of the tightening that they'd like to see. And I think that tone is going to basically continue. So even if they were to pause in September, they're going to be doing everything they can to sort of shift it towards a very hawkish pause and basically dampen that kind of mood at this stage, because it doesn't help them doing their job basically.
Right. What is a China that struggles to get economic growth off the ground mean for Europe in the midst of all of this, Henry?
Yes, I mean China is obviously a stronger China would help European exports, autos, manufacturing, machinery in particular. That being said, I think the weakness of the global market, I think it's probably less of a risk to European manufacturing in particular than just the systematic changes in the structure of the European economy, from higher energy prices and a much more competitive Chinese auto sector. So things like batteries, EVs, China is doing incredibly well in sort of surging ahead, almost taking sort of second mover advantage versus elsewhere, whilst Europe is comparatively having a much harder time on that front. So I think all things equal, a stronger China should help European exports. But you also need to look at where the Chinese growth is coming from. So if their consumption is more shifted towards services, that benefits Europe less. And equally, as we've seen with the support last week, if it's all around housing, getting first-time buyers more into the market, supporting parents, for instance, that's going to have less of an impact on the European exports than other measures would have. So I think there is nuance to it at this stage, and it's not an entirely positive story.
I mean, the nuances are screaming from the macro picture, Henry, because I look at things, for example, not just China growth, perhaps not living up to expectations that we had this year, but things like, for example, of India's GDP set to grow at 7%, while at the same time Sweden and Chile are set to see their economies shrink this year. How much of the end of 2023 and 2024 is going to be about this global divergence of growth? And are there any screaming buys or sell to you within that context?
So, I mean, I think the divergence in certainly the European context is going to be a lot around energy intensity. So I suppose I said it already, but it bears repeating just how structurally changed the European energy market is now versus it was before Russia's invasion of Ukraine. But they're now much more exposed to sort of global markets in terms of LNG, for instance, as we saw with Australia strikes. Australia doesn't really export any LNG to Europe, and yet European gas prices were rising on that, and that's partly just that exposure to LNG rather than piped gas is going to make us more global, sort of exposed to global markets. And it's the same with geopolitics. So there's going to be a lot of concern, I think, in Europe, particularly European industry, around securing supply for energy and insulating against kind of the sort of geopolitical upheavals that we might see particularly in the regions where Europe does buy a lot of energy from. That's certainly within the European context. From an international perspective, I think whilst I'm sort of not that au fait with Indian and Swedish growth, certainly one of the themes that we've been seeing is around and in terms of sort of particularly on equity side, European equities in a sort of stagflation environment, we'd be sort of more bearish on. particularly things like home builders, for instance, probably value being more long sort of staples versus that in that kind of environment. And the overall sort of politics in Europe has definitely, and we've sort of been flagging this for a while, had a much stronger lean towards targeting profits.
Okay, Henry, I'm afraid we're going to have to end it there. But Henry, thank you so much for joining us. Really appreciate your thoughts this morning. Henry Occleston of Macro Hive. All right, let's get further.